Welcome to today's Explainer. Look, if you've ever stared at a stock chart and felt like you were looking at absolute, total chaos, believe me, you are not alone. The jagged lines, those completely sudden drops, the unpredictable surges, it can all feel entirely random, like a casino. But what if I told you there's actually a hidden structure beneath all of it? That the market is less like a slot machine and much, much more like a strategic game being played by very specific rules. Well, today, we're going to decode those exact rules.
Okay, let's dive right into this. It's the ultimate question, isn't it? Is the stock market playing you? See, so many investors approach the market purely on emotion. They react to flashy headlines, letting fear or greed guide their hands. And in this kind of strategic game, emotional players, they almost always lose. To stop being just a pawn on the board and start playing like a grandmaster, we first need to truly understand the fundamental environment of the game itself.
All right, Section 1, the board. We're talking bull versus bear markets.
Every game needs a board, right? And ours is split into two very distinct territories. At their absolute core, these markets are defined by simple math. A bull market happens when investment prices have risen 20% or more from a previous low for a sustained period. This is usually driven by the good stuff: strong economic indicators, corporate earnings growth, low unemployment. A bear market, on the flip side, is officially recognized when prices fall 20% or more from recent highs. These periods generally line up with a weakening economy and a massive liquidation of securities. So it's a pretty stark contrast between a 20% rise and a 20% fall.
Now, what's really fascinating here is how human psychology overlays that simple math. The public's frantic emotions are what actually drive these market swings. In a bull market, the mood is euphoric. Investors are confident, they're happy, and they're eager to throw more money in. But, this can lead to what we call irrational exuberance, basically taking on way too much risk just because of a fear of missing out. Conversely, in a bear market, panic and fear completely take the wheel. Investors become terrified as they watch their portfolios shrink, often fleeing for the perceived safety of cash or fixed income securities, and usually selling at the absolute worst possible time.
Let's anchor this in some hard data from Charles Schwab to put it into perspective. Historically, bull markets run much, much longer and push prices significantly higher than the relatively short, sharp drops of bear markets. Just look at these numbers. A bear market lasts an average of roughly 14 months with an average decline of 34%. But a bull market, it averages a lifespan of 60 months. That's 5 whole years with an astounding average rise of 165%. So yeah, while bear markets are absolutely terrifying in the moment, history shows us that the bulls have fundamentally dominated the broader U.S. stock market over time.
Moving on to Section 2, the rules, because the market does actually follow some fascinating theories.
So we understand the board, but how exactly do the pieces move? The market isn't just a random walk. It follows predictable, historical theories that try to map out all that investor behavior we just talked about. Our first rulebook comes from Charles Dow, literally the bedrock of modern technical analysis. Dow theory asserts that astute investors completely ignore the daily noise to focus on the big picture. He broke market movements down into 3 concurrent trends. First, you have the primary trend. This is the major, multi-year direction, either a bull or a bear. Second, the secondary trend, representing medium-term corrections lasting weeks to months that move against that primary trend. Think of it like a temporary pullback during a massive bull run. And finally, the minor trend. That's the short-term daily noise, basically the anxiety you feel checking your portfolio app every 5 minutes. The real secret? Knowing which trend you're actually looking at.
Building right on top of that, we have Ralph Nelson Elliott's wave theory from the 1930s. Elliott proposed that collective investor psychology repeatedly moves the market in very specific wave patterns. In a rising trend, you're going to see a 5-3 pattern. That's 5 upward impulse waves, where waves 1, 3, and 5 move up, and 2 and 4 are just corrective dips. This whole sequence is then immediately followed by 3 downward corrective waves. By recognizing these repetitive psychological waves, traders actually attempt to forecast exactly where they are in a market cycle, identifying prime buying opportunities right before the next wave crests.
Which brings us to Section 3, the puppet master. Time to meet the Composite Man.
If retail investors are out there reacting emotionally to every little thing, who is actually orchestrating the broader moves? Well, early 20th century pioneer Richard D. Wyckoff said something absolutely fascinating. He said, all the fluctuations in the market and in all the various stocks should be studied as if they were the result of one man's operations. Let us call him the Composite Man, who in theory sits behind the scenes and manipulates the stocks to your disadvantage if you do not understand the game as he plays it, and to your great profit if you do understand it. Wyckoff desperately wanted everyday retail investors to understand how the smart money actually operates. So, who or what exactly is this Composite Man? Basically, he's a theoretical entity representing the smart money. We're talking the large institutional forces, the whales, the massive funds that completely dominate the market. While the average retail investor is out there playing the game with panic and euphoria, the Composite Man plays it with cold, calculated patience. He carefully plans, executes, and concludes his campaigns. He's buying when there is absolute blood in the streets and selling when everyone else is throwing a party.
All right, Section 4, Phases of the Cycle. Let's break down Wyckoff's game plan.
If we know who our antagonist is, we need to understand his strategy, right? Let's walk through how this builds across Wyckoff's 4 distinct chronological phases. First up comes accumulation. This lasts for months. It's where large institutions quietly buy up supply at rock-bottom prices. Next is the markup phase, lasting for years. This is the bull market we all recognize and love. Prices break out and rise rapidly as demand finally exceeds supply. Then comes distribution, lasting months, where the institution starts strategically selling their shares back to late-stage retail buyers at premium prices. Finally, the markdown phase, also lasting months. That's the bear market, where prices fall rapidly because supply utterly overwhelms demand.
Actually, let's look a little closer at the stark contrast in behavior during those 2 transitional phases. During accumulation, the smart money is quietly buying low. It happens during peak pessimism, right at the bitter end of a bear market when ordinary investors are fully convinced things will only get worse. But during distribution, the smart money is selling high. They are distributing their holdings to an overly optimistic, totally euphoric public right before the market tops out. The Composite Man literally does the exact opposite of what the emotional public is doing at the exact same time. It's wild.
Which leads us to Section 5, your market playbook. Let's talk about protecting your portfolio. Because knowing the rules is great, but how do you actually use this to protect your own hard-earned money? When the bull is running, during that markup phase, your strategy should aim to capture appreciation without falling victim to that irrational exuberance we talked about. Key plays here include growth and momentum investing, really focusing on the sectors that are leading the expansion. A solid buy and hold approach lets you ride that multi-year upward trajectory. And don't forget to buy the dips, purchasing high-conviction stocks during those temporary minor secondary corrections. Just remember, don't get overly confident. The bull doesn't run forever.
So, the crucial point is knowing how to survive when the bear strikes during the markdown phase. Here, your focus violently shifts to risk management. Defensive positioning is absolutely key. Reallocating assets into recession-proof sectors like utilities, consumer staples, or healthcare. You also want to focus heavily on preserving capital, perhaps increasing your cash reserves or utilizing fixed income instruments. And most importantly, avoid the temptation to time the absolute bottom. Seriously, trying to catch a falling knife in a panic will only leave you wounded.
Now, there is one strategy that works as the ultimate emotion-free weapon against the Composite Man in almost any market: dollar cost averaging, or DCA. This is simply the strategy of investing a fixed amount of money at regular intervals, completely regardless of the share price. In a bull market, it stops you from dumping all your cash at the absolute top. In a bear market, it allows you to safely accumulate discounted shares of solid companies over time without trying to guess when the bleeding will finally stop. It takes the emotion right out of it. Another essential tactic is to cast a wide net through diversification. And look, you don't need 1,000 stocks to be safe. By spreading your investments across major sectors, using as few as 12 carefully chosen stocks, you can effectively manage a risk. Diversifying your portfolio is basically like spreading your pieces across the game board. It ensures that even if one specific industry crashes and burns, your overall portfolio survives the hit and can still catch the market winners when the next bull run begins. And this brilliantly illustrates our main takeaway for today's explainer. The stock market isn't a chaotic casino, it's a structured, cyclical environment driven by human psychology and institutional strategy. By understanding Dow's trends, Elliott's waves, and Wyckoff's phases, and by keeping your fear and greed strictly in check, you can completely flip the script. Discipline and structure ultimately beat out emotion every single time. You can position yourself to invest right alongside the smart money rather than constantly trading against it.
So, as we wrap things up today, I want you to take a hard look at your own portfolio. Reflect on your recent trading decisions and ask yourself one final provocative question. Are you playing the Composite Man's game, or is he playing yours?